Hello and welcome. If you've been keeping an eye on the silver market lately, you know it's been on a roller coaster. But what if I told you that the key to understanding what's happening right now isn't in today's news? What if the answer is hidden in a very specific pattern from the past?
You've probably seen the headlines. Silver prices just shooting up to these incredible highs, only to pull back just as quickly. It's enough to give anyone whiplash. And it's left a lot of folks scratching their heads and wondering, what on earth is really going on here? Well, here's the thing. To really understand today's price swings, we might not need to look at this week's financial reports at all. Because you see, it feels like we've seen this movie before. So let's dive in and see if we can figure out the plot. Okay, before we go any further, there's one key term we all need to be on the same page about. It's margin requirement. Now, the easiest way to think about this is to picture a security deposit. It's simply the cash that traders have to put up front to make a trade. So when you hear that an exchange hikes the margins, all it means is they're raising that deposit. It's getting more expensive to play the game.
And that brings us right up to today and the puzzle of silver's recent wild ride. So here's what just went down. Silver's price absolutely rocketed up to a new record high, over $83 an ounce. Then, almost immediately, a major exchange called the CME Group stepped in, and they announced not one, but two margin hikes in a single week. And what happened right after that? The price pulled back, and it did it fast.
Now, for anyone who was watching the markets back around 2011, this whole sequence of events, a massive price spike followed by margin hikes, well, it might be giving you a serious case of déjà vu. And this is our first big clue. So let's turn the clock back to 2011. In late April, silver hit a huge peak, nearly $50 an ounce. It was a massive run-up. So what happened next? Well, over just a 2-week period, the CME Group unleashed a flurry of margin hikes, 5 of them in rapid succession. They made it much, much more expensive to trade silver futures. And the effect of those hikes was, well, it was dramatic. In the months that followed, from that peak in April all the way through December, the price of silver just collapsed. It fell by a staggering 40 to 45%. All right, now let's jump forward 10 years to February 2021. I think a lot of us remember this time. It was that whole social media-fueled market frenzy, and wouldn't you know it, silver was right in the middle of that storm too. On February 1st, 2021, a huge wave of enthusiasm from investors on sites like Reddit sent silver soaring to an 8-year high. So what do you think happened? You guessed it. On the very same day that the price peaked, the CME Group announced an 18% margin hike. The pattern was playing out all over again. And just like back in 2011, the result was pretty similar. Over the next couple of months, silver saw a pretty significant sell-off of 21% from its peak. Basically, it erased all the gains from that big rally. If you're finding this little bit of historical detective work interesting, please take a quick second to hit that like button and maybe subscribe so you don't miss any of our future updates. It really helps. Okay, so now we have our clues from 2011 and 2021. Let's put them on the table right next to what's happening today. Because when you do that, a very, very clear pattern starts to jump out. It really seems to boil down to a simple 3-step dance. Step 1, you get a huge, fast run-up in the price of silver. Step 2, the CME Group steps onto the dance floor and announces those margin hikes. And Step 3, the price of silver falls, and usually pretty significantly. Seeing it all laid out like this really makes it obvious, doesn't it? In 2011, you had a record high, 5 hikes, and a massive 40 to 45% drop. In 2021, a Reddit surge, just 1 hike, and a 21% drop. And that brings us to today, another record high, 2 hikes so far, and a big ol' question mark for that last column. The parallel is, well, it's hard to ignore. Oh, and get this. The official reason the CMEs gave for raising margins this time around was, and I'm quoting here, it was based upon a review of market volatility to ensure adequate collateral coverage. Does that sound familiar? It should, because that is almost the exact same sentence they used back in 2021. It's like they're reading from the very same script. So, this all leads to the big question, doesn't it? What does this historical pattern suggest might happen next? Now, of course, no one can predict a future, but we can look to the past to get a sense of the possibilities. Now, let me be very clear, we are not making any predictions here. But let's just do some simple, what you might call cocktail napkin math.
If we saw a repeat of the 2021 pattern, a 20% drop from that recent high would be about $16 and change. But if it looked more like 2011, a 45% drop would be a much, much steeper fall of over $37.
Ultimately, what we've talked about today isn't financial advice. It's simply a lesson drawn from history. And it leaves us with one final thought-provoking question. You know the old saying, history doesn't repeat, but it often rhymes. Is the silver market hearing a very familiar tune right now? Thanks for watching.